So team alternatives. So the first thing is the cash flow. When there are profits, investors are actually partners, so they usually receive a share of those profits in the form of cash distribution. So it is much more bankable cash flow than what you would see in the traditional side, because the underlying asset is not fluctuating in price, but it's still paying out a healthy dividend. Inflation hedge. If a physical asset is purchased in an inflationary environment using low-cost fixed debt, the fixed debt can serve as a powerful inflationary hedge and lower the cost of the asset over the time of the loan. Also, the inflationary cost can be passed on to the consumer of the asset. So this is a great example. On our last property in Pennsylvania, we bought a 50-unit apartment building with a 3.8% debt instrument for 10 years fixed, no floating rate, no nothing. So if the inflation, as it is 7-8%, if that stays sustained for 2, 3, 4 years, then the property itself would have gotten cheaper by the difference between what we're paying in interest and what the current inflation rate is. So that's super powerful. In addition to that, is we are allowed to raise that rent by usually the cost of living adjustment, which is based on the inflation. So again, our main costs are fixed, but the top line numbers can be easily changed because of inflation in our favor. Next is lower volatility. Most alternative investments are private securities. There is limited liquidity for this type of investment. You will not see dramatic short-term asset fluctuations, which help avoid panic selling. Because as much as people like to say in hindsight how they weathered the storm, when they see their entire portfolio going down, they are always tempted to sell and try to get back in at a lower price. So I think not having that option for a portion of your portfolio is actually a really good thing. So again, continuing with the advantages, next is tax advantages. When you invest in syndication, you get Schedule Ks at the end of the year. And with those Schedule Ks, they pass on depreciation. So usually you could receive 2, 3, 4 years of distributions and actually show negative Schedule Ks because of the large depreciation. So it makes those first couple of years of cash distribution very, very tax friendly. I want to be careful about how much I glorify tax advantages, because too many operators out there are talking about the tax advantages without talking about the depreciation recapture and a lot of other things that you have to plan around when you get into the alternative space. But for now, we'll just keep it strictly on the distributions, and the distributions are pretty tax friendly because of the depreciation that's usually passed through when you're an equity investor. Next is leverage. So using long-term fixed debt allows the investor to invest the minimum amount but receive 100% of the benefits of the scale of a larger asset affords. So in a situation like our apartment building, the last one we bought, we only put 30% down, but we still get the benefits of the entire property. So even though we only put down $2 million, we're getting the benefits of the $6-7 million property that we purchased. Passive. Most investors are not required to participate in the ongoing affairs of the investment and remain passive throughout that investment. The only nuance here is that sometimes we do JVs and joint ventures, and in those situations, those investors have to be active. And so there is a little bit of activity, but for the most part, after you wire the funds, you're not involved into the day-to-day of the operations, and you have a team that is creating those distributions for you.